the key here is what actually makes you uncomfortable. I'll give you a few examples. I don't watch TV anymore at all. TV makes me uncomfortable. When someone else is talking fear, it causes me to be fearful. I transfer that fear. When I read, it's not that big of a deal. So I really try not to listen or watch the news because it makes me very fearful. And so whatever you're doing, checking your phone, having, constant updates in markets, whatever you're doing, if it's making you uncomfortable, don't do it. Just don't do it. You can't become comfortable with it, I don't think. Hey everybody, this is Kevin with Leading Edge. Hope you're doing well. Today we're going to talk about the good news and about how we can change our behaviors, our activities to better enjoy the investment process. Okay, that's what today is all about. It might even change the way you feel about your life and some of the things that you consume on a daily basis that are toxic. And I'm not talking food or alcohol. I'm talking the information that comes into our mind. But the way we hear it from clients is they don't say investing makes me feel uncomfortable. They usually will say, well, I don't really want to invest my money. I'm unhappy with my investments. I don't like the way the money makes me feel, all these kinds of things. And it's really because of the news we watch, the items we discuss, the information that we talk about, the conspiracies that we dwell on. There's a lot wrong with the world. I'll definitely admit that right up front. There's a lot wrong. But these are the questions to ask yourself while you're viewing this presentation is what if you believe what we believe? What if you were to believe what we believe? How would there be a theoretical benefit for you? How may it change your investing life? Okay, now I didn't say investment returns, I said your investment life. And then this is the return part. Think about yourself in 10 years having used our approach. And our approach is not, it's not really Leading Edge's approach, it's the approach that many of the academics have put forth. Will it be better or will it be worse than the alternative? So will you have better returns? Maybe. Nobody can say that you'll have better returns. Now, the good information with these is that I can take myself out of this discussion here and say you don't need a financial planner to do these items. You don't need a financial planner to do investing. You can do investing yourself with some of the theories that I'm going to present here. So here's the reason why we sometimes have to be uncomfortable. So comfortable investors should maybe be uncomfortable. So it's the purchasing power. You take a $100 bill, you put it under your mattress, you come back in 10 years, you have 3% inflation. Well, guess what? You felt good all 10 years knowing that $100 bill was under the mattress. You come to go to spend that bill, and now you can only buy 77% of what you could have bought before. So by not taking any risk, you're taking a risk with inflation. And really staying ahead of inflation is the key of most investors. You see money, we're either going to spend it now or we're going to spend it in the future, or somebody else is going to spend it in the future, or we're going to give it away so they can spend it on other people in the future. But inflation is really the reason why risk assets are something that are a part of many of our clients' lives. So paying attention to the news and the newest trends, I'm going to show you in a second that I don't think it helps the majority of people. Now, can it help you? Can you come up with some investment strategy that works better than everyone else? Yes, you could. That's part of the problem, is it is possible. It's just not probable. And again, I'll show you that data, but being hyper-focused on your investments, being hyper-focused on the news, on trends, does not really help you with investing. So if you have a group of friends that you all talk about certain things, then being up on the news is absolutely great. The news on the Tennessee Volunteers is absolutely, I get a lot of value from that because I talk to people that I know and care about, and it's good for me to be up on what's going on. But with investment news, I think it causes a lot of pain. And I would just say general news, like if you watch the news and you became, I was told when I was a kid, if you're a good citizen, you're going to read the paper. Well, if you were to focus on everything in the news, how does it really improve your ability to be a good citizen or a good person? I think that's kind of iffy. It's good to know what's going on. Again, you don't want to be perceived to be an idiot, but being hyper focused on this stuff is just not helpful. So daily market news and commentary can challenge your investment discipline. Absolutely. Number one thing we get asked as financial planners is, should we sell stocks now? And then I say, why do you say that? And they say, well, I just heard, one of my friends said, a fellow colleague just said that we got to get out. This bad thing is happening. We got to get out. Or there's a recession coming. And I'm like, oh, yeah, yes, there's always a recession coming. But if you knew exactly the date of the recession, okay, January of this year, 99.9% of all economists predicted a recession for 2023. They were wrong. But what if they were exactly right? When would you sell during the recession? Usually when the recession's in full tilt, it's probably too late. So the funds to own, I'll show you in a second why, trying to find the smart person out there, the next Warren Buffett, is very challenging. It can be done, once again, very challenging. What about if the market goes to an all-time high? That's something that people get very upset about. The market is now at an all-time high. What do I do? Should I sell stocks now? There's going to be a recession. All of these things go together. So these people must pay attention. The people I'm going to show you, these are all the professional money managers. They manage money for others. They get paid to pay attention. Their returns are, I say 1/3 good and 2/3 less good. This is from a book that I had read multiple times. It's not quite 1/3. 2/3, it's 39%. So 39% of the time, these money managers that focus, should I buy, should I sell, should I market time, 39%, they beat the S&P 500 over the last 25 calendar years. And you can see the slim pickings have been pretty slim. If you just put your money in index funds, you would do better. 60% of the time. That's why I say you don't need to have an advisor to follow this type of thinking. So not paying attention, you won 60% of the time. That's pretty doggone good. Now that's large cap. Okay, let's look at small cap. And this is from, by the way, this was from the CFA Institute, and it was written by the people from American Funds, who are terrific people. They have terrific funds. I think they're a little less active than some of these others, and they have done very well over time. This is the SPIVA U.S. scorecard ending in 2022, and this looked at small cap indexes, okay? Now, we take the smartest person. The thought is that smaller companies are easier to pick the winners. If you do a lot of diligence, you follow the news, you follow what's going to happen next, and underperformance. So 60% beat the index in 2022. Hooray! Paying attention really did make a difference in 2022. But then when we go out to 3 years, the data is very similar, where we get to about the 2/3, 1/3 again, and in 5 years, not even close. The index has beaten the person who's paying attention. So do you have to pay attention? This is some sneaky language that this is the Edge browser, and you can see here I was warned during the day when I logged on that these investments were dropping fast. So dropping fast is a way to say that I better do something, right? This is a you better do something. And so I looked at this, and it even startled me. I mean, I don't believe in doing something with data, but I mean, when this says dropping fast, that tells me it's going to continue to drop, which it did not that day. It dropped fast, but it did not continue to drop fast. So why is it so hard to be able to pay attention to markets and misery and beat what the market does? Well, it's because the market is an effective information processing machine. What I mean by that is there's people in Japan, in U.S., South America, Antarctica, wherever there's people that are able to buy and sell stocks, we set the price, and it's not the right price. I know people that have condemned efficient market hypothesis say it's not the right price. No, it's not the right price. Could be very wrong, but it's the best estimate of pricing. And what changes the price of those companies is what happens next in the future, i.e., not before, unless before information gets highlighted by somebody in the future. So just trying to focus your life on worrying about your investments, you might as well just go with markets. Now, I started in 2008 and 2009, and I was taught a terrible lesson. The markets crashed down. I watched the news every night. I watched CNBC every night. It was very, very miserable. I only had a few clients, including my family. Very miserable. Now, if you just stayed the course there, everything worked out. Now, there was a possibility that, the U.S. economy could have come crashing down. It really did. I'm not being dramatic there. But how does paying attention, even in these most nasty times, actually help your investment returns? The other thing that I find super interesting with this chart is, look, small cap, small cap, small cap, small cap, all over the place. Going into a year and saying, I think this is going to do better than this. That's what makes this investing thing so hard. I mean, large cap in this 2008 to 2022, this is my investment life so far as a financial planner, 8.8 for large cap. REITs, 6.6. Remember these two. And then emerging markets, especially remember this one, did 1%. 1%. I can't get anyone that wants to buy all emerging markets right now. Now, this 20-year time period, this is, a few years earlier, and it's 20 years, 2001 to 2020. REITs were number one, emerging markets was number two. So even if you studied all the emerging markets in the last, 15 years, didn't matter if you studied them all, because the marketplaces themselves had no returns. Okay, so yes, the investors with the best returns were dead. Now, we don't hope for clients that are dead. We don't want to be dead investors. But this study came out from Fidelity 2003 and 2013. I'm sure there's some caveats. I've heard about this study before, but they were looking for accounts that were doing the best. Consistently, these accounts with the best returns belong to people who had either died or just lost their login, didn't know they had accounts, weren't messing with anything. So this kind of tells us, again, on average, by not paying so much attention and worrying about it, it's not that important. Now, what planners do is we look at time horizon. When do you want to have certain investments that you can take money out? What's the time horizon? There's a lot of other things that planners do, but for investment returns, it's really all about investing. And if markets show up good, you're going to get good returns. If markets show up bad, by the way, even if you're paying attention, you'll probably still get pretty bad returns, unless you're the guy from The Big Short, who his investment returns the last 14 years have been terrible. They were quite good when he did The Big Short. So 2020 is probably the greatest example in my life of how fear, hypervigilance, OCD behavior did not help in investment markets. And I do realize that 2020 was a bigger year than just investments. I mean, it was just downright scary. It messed up our kids. It messed us all up. But when it comes to investing, it was not helpful to stay focused on markets or listening to the pundits. I mean, the market started going down and it just kind of collapsed, down 33% in very few days. It was scary how fast it went down. And of course, the market finished higher. Oh, by the way, there was an election. We voted in a new president. The election wasn't settled. There was a lot that was bad in 2020. And yet still markets were higher. So paying attention didn't really help that much. Probably got you out of the market and into cash. So here is the solution. How to become comfortable with discomfort. I don't think you can. So we get paid to watch markets. We get paid to have answers to questions. And we try to pay attention to what's going on, but we do not allow how we feel to make changes in our portfolios. And we discuss that often because it's really hard to stay the course when things are bad. And it's also hard to stay the course when things are great and something else is doing better. We want to change the investments. So the key here is what actually makes you uncomfortable. I'll give you a few examples. I don't watch TV anymore at all. TV makes me uncomfortable. When someone else is talking fear, it causes me to be fearful. I transfer that fear. When I read, it's not that big of a deal. So I really try not to listen or watch the news because it makes me very fearful. And so whatever you're doing, checking your phone, having, constant updates in markets, whatever you're doing, if it's making you uncomfortable, don't do it. Just don't do it. You can't become comfortable with it, I don't think. So is the fear a healthy type of fear? What I mean by that, if you're driving down the road and there's a truck pulling out and you go to the left, that's great that you were vigilant about the truck coming out because it was a healthy fear. But if you're driving down the road constantly looking for trucks everywhere, looking for bad things everywhere, looking for the next market crash, that is very destructive and not helpful at all. So what ends up happening quite a lot with people that I've spoken with is they say, I'm going to stay the course. And I say, okay, good. And then they constantly make themselves miserable with what's going on. And I say, are you okay? Yeah, I don't want to do anything. I just, this stuff is just making me miserable. And it's like, why? Why are you doing it? Pay attention to something else. Go for a walk. Start working on the garden. I don't know that anyone really enjoys watching 4 hours of news a day. But anyway, I know people do it. And I know some family members that do it, but I just don't know how that really helps us in any way. So when you've decided you're going to be a long-term investor and then you're constantly looking for things to fear, you're just kind of taking fear along with you for the ride. And then eventually it might cause you to do something bad. So hopefully that's when a financial person will come in and help. So in essence, why should you do what we think is important to do? What's in your benefit? Why might you do it? Why might you let markets work for you? How's that going to change your investment life? This definitely will change your investment life when you just say, look, I'm going to be part of the markets, allow the markets power. And if the markets do well, I will get good returns. If the markets don't do well, I will not get great returns, and that's unfortunate. But me against the world, me trying to figure out what I need to be hyper-focused on, it usually doesn't help. So anyway, hopefully you at least can see why I say that paying attention to markets on a consistent basis, paying attention to the news, the greatest new fear, is just not helpful. Thanks so much for watching.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.